Hello and a warm welcome to Talking Stocks. I am Gugulethu Cele. In studio with me is Sean Ashton and Hechter, both from Anchor Capital. Now today we're talking Steinhoff, a South African-based international furniture and household goods retail chain firm which operates in Europe, Africa and Australasia. Gentlemen, thank you so much for joining us. I think when we think Steinhoff, certainly one of those fantastic South African companies, share price is really rallied and looking for that constant offshore exposure. Clearly, Marcus Jooste and his team doing a good job here so far?
I think they're doing a fantastic job and it's become a very global business. I don't think that Steinhoff was always given the credit for what they've achieved to date. If you look back 3 years ago, this was quite a lowly rated share. You could buy it at a forward 6 or 7 times P multiple. People still had a lot of concerns around the extent of the goodwill in their balance sheet, the amount of debt that they were using to acquire. But I think as they've continually built out their business offshore and demonstrated an ability to pull margin out of acquired companies, I think the market has come to appreciate the ability of this business to actually bring value to what they're buying.
And clearly the face of this company has changed, because before it was more closely linked to JD Group, but that phasing away slightly with the more European-focused Conforama.
Absolutely, it's now largely a European integrated furniture manufacturer and sourcer of household goods. And really, I think if you think about what's probably been the most successful of the transactions they've done in the last couple of years, aside from what they've announced more recently, which is not concluded, but Conforama is a great example where they bought a business back in 2011. The trading margins were something like 3.5% or so, and they've managed to eke out margin to the extent that they're now operating that business at 6.8% margins. And really the whole thesis around that particular company was to say, here we've got a business which is operating below its potential. We can increase margins through two things: bring better sourcing to bear in terms of their global sourcing ability, pricing power that they have as such a large buyer of furniture product around the world, and also improving the mix of what they're selling in that business, less electronic goods and more decorative homeware items to try and bring that margin up. And they've demonstrated a phenomenal ability to create value that way.
What about Pepkor? Because that's certainly what we all can recall being one of the biggest deals that took place just last year. Quite a significant chunk, and I understand the numbers were recently included in the company's results?
Yes, so in terms of the Pepkor transaction, they bought it out of the Brait stable in a deal that was certainly lifted the profile of the entire group. When we looked at that transaction, we thought Pepkor would fit very well into the greater Steinhoff group. We think that the market possibly initially underestimated Steinhoff's ability to eke out margins in the acquisitions, and now that they've got sort of a better track record of that, the margins have come through and the market's starting to place quite a nice multiple on those Pepkor earnings. So what it also has done is increase their cash flow ability. Pepkor is highly cash generative, which increases their ability to take on more debt and service high levels of debt. So in terms of the transaction, there was a big shift in the capital structure. They were able to do it with predominantly equity, so a lot of the Pepkor shareholders were satisfied with taking on Steinhoff equity, which decreased the net debt to equity ratio of the entire group and gave the management the flexibility to carry on doing M&A activity in Europe.
If we do look at the revenue split, though, significant amount of this definitely coming from Europe and the UK. They've also come into a bit of trouble there when it comes to tax regulations, but is that perhaps a small hurdle within its freeway of growth and projections?
We don't yet have any certainty on that. I think certainly our discussions with the management team seem to indicate that the tax query that they've had relating to that raid that was announced a couple of months back in the European, one of the European subsidiaries, it likely relates to a previous query they've had from the same tax office, with which the company believes that they've dealt with that satisfactorily, but the tax authorities are coming from a slightly different angle, and time will tell. So we don't believe it's a material concern of theirs. But again, as with anything in tax, you can never have full certainty.
Exactly. But if we do look at another bid, though, for home retail, I understand based in the UK, and
yes.
There's several comparisons here that there might be synergies, but also maybe not in detail.
So this is a catalogue and internet retailer of homewares again, so quite similarly aligned to some of the businesses that they own in Europe, but obviously this is more UK focused. And I think it reminds me a lot of the Conforama type of transaction that they did, in the sense that here you've got a business where the operating margins have gone from 5% down to 2.5% over the last 5 years or so. Granted, there's a subsidiary in there called Homebase which pulls those margins down significantly, but they're going to be selling that off. The core margin of what they're buying, which is the Argos internet retailer, is about 3% or so. But again, we would expect that a lot of the rationale for buying this business would be to bring better sourcing to bear on it, better pricing for the products that they buy, and possibly better mix, similar to Conforama. And Sainsbury's is also a competing bidder for this particular asset. In fact, there seems to be some media noise right now that they've upped their bid. That hasn't yet been confirmed. But really, Sainsbury's has really come out and said we expect to achieve synergies of about £120 million if they acquire that asset. This is a business that makes a bottom line of about £75 million. So if Steinhoff could achieve the same type of synergies with that particular business, in other words, more than doubling margins, it would probably add, in our estimates, about 10 to 11% to what we would expect Steinhoff could make in terms of profitability next year.
Sure.
So it's a material transaction if they can bring synergies or extract synergies from the business. But at the outset, it should be broadly earnings neutral to slightly positive.
From a competition point of view, would this probably rank it more closely to Home Depot, or number one, or competing directly with Home Depot, or because Home Depot has more of a US exposure, if I'm not mistaken?
Yeah, it's very much US centric. This is still significantly, well, at its core, it's a UK operator.
If we do take a look rather at with regard to acquisitions, as well as the fact that they deleveraged through equity on that front, walk us through the graph here, because it takes us back to 2005. What are the trends that we see till now?
So you've had this, I think the first point to make is that Steinhoff has never really been all that frightened of debt. They've been quite prepared to have a leveraged balance sheet over time. Where we sit right now in terms of debt to equity and interest cover is probably amongst the most conservatively positioned that they've been. So you've probably got, post all these transactions, interest cover of about 5 times or so, debt to equity of about 20%. So ultimately, we think they do have the firepower to be able to go out there and acquire more businesses. I think the other point I'd make is that when you look at this last set of numbers that they've reported, cash flow growth was significantly stronger than the actual reported profitability in terms of the uplift in profits. So they've been very good at controlling working capital of late, and that's flowed through quite nicely into cash generated from operations. So a lot of the criticisms that Steinhoff used to have as a business, we think are being addressed in actual delivery. The cash flows are there. So we believe they can support more debt on their balance sheet.
If we do take a look, though, at the growth prospects for this company, surely fundamentally some of the organic growth features are there, but do we want them to actually go about and look for further acquisitions, especially defensive ones? Is it difficult for them to actually find opportunities of value now?
I think it depends on the profile of what they're buying, and you've got to understand the reasons of why they're particularly buying an asset. When you look at Pepkor, it wasn't obvious that it was a cheap transaction. In fact, they paid quite a high price for it. It's not obvious that it was a badly run business either. I think more of the synergies related to potentially the fact that there was real estate co-investment opportunities in the European business units of Pepkor, where Steinhoff has a lot of underutilized property that they can have a store within a store or an additional store on those premises. When you look at the likes of Conforama, potentially the home retail operation, there's something that's underperforming, and they can bring their global sourcing expertise to bear on extracting value from that business. If it's just buying businesses for the sake of buying businesses, then that's a bad idea. And I think organically as well, Steinhoff has the ability to consolidate their markets, given that outside of the top two, which is really IKEA and themselves in Europe, you've got a very fragmented furniture market. With players that don't have the scale that they have. So they should be able to take market share organically without having to pay goodwill.
Having said that, though, the management team, are we still happy with Marcus Jooste and the direction that he's led the company into? Because not so much more of a South African focus, because evidently, looking at the observations we've made on the chart here, when you buy a Steinhoff, you're not buying it for JD or CAP, more for the Conforama exposure.
So I think the management team have done a great job in convincing the market of their execution ability. And I think, below Marcus Jooste, I think there's a great tier of management that are operating the sort of day-to-day operations of the businesses in the group very well. It's a very big company, so Marcus Jooste can't be involved in all of the different companies as intricately as he probably would like to. So he's got a very strong second tier of management there. And I think their positioning in Europe is fairly defensive because they operate in that discount sort of furniture and retail chain. And I think that the organic growth, they've taken advantage of the fact that people have been looking around for value in those areas. So I think that they've strategically made the right decisions, the right areas of the market to be in. And at the same time, they've taken advantage of very cheap debt in Europe. So we think the debt, at the moment, the interest expense is about 6%, and we think that should trend down to about 3.5% over the next 3 years. So the cost of refinancing the debt, is very accretive to earnings for a company like Steinhoff.
Well, let's find out from our analysts whether they buy, hold, or sell this particular stock. Sean, let's start with you. Buy, hold, or sell Steinhoff?
So I'm going to go with a buy. I think it has been performing quite well of late, but you can still buy this company at a forward, we would estimate 17 times P multiple. It's quite difficult to compare it to peers because it's actually a fairly unique asset globally. If you look at the type of scale that they've got in the European furniture market, your biggest competitor is IKEA and they're not listed. But I think certainly when one takes into account the cost of money considerations, how low interest rates are in Europe, to be able to get kind of north of a 3% dividend yield, which is what we think they'd be paying, and the kind of rating that it trades at, we think it still offers reasonably good value. And I don't believe that the acquisition and organic market share led growth story has necessarily ended for them. I think there's a number of years yet to run.
Liam, your view?
Sure. So, when looking at Steinhoff in our local universe, Steinhoff definitely is one of the companies that operationally has got the momentum going for it, with less macro headwinds than a company in South Africa that's possibly completely geared to the South African market. So I think for South African investors, they should certainly hold Steinhoff as part of a diversified portfolio. And ultimately what Sean said, I completely agree with. This is a buy, and we own a lot of it, and we'll continue to do so.
And the Frankfurt listing, that's just a boost of confidence and them getting exposure to European investors. But
it opens it up to another set of shareholders who, in certain instances, a lot of these shareholders cannot own emerging market stocks, for example. So if you're listed on that exchange, it's a new opportunity set for new investors.
We'll leave it there for today. So clearly a buy recommendation coming through for Steinhoff. A big thank you to both my guests, Sean Ashton and Liam Hechter, both from Anchor Capital. Join us again next time, though, where we talk more stocks.